most important line from Ben Graham's security analysis is actually a quote from the Roman poet Horace. Many shall be restored that now are fallen, and many shall fall that now are in honor. Over the last decade, no sector epitomizes this truth more than public sector banks. I can recall the consensus bearish view on public sector banks and PSUs more generally 10 years back. Public sector banks are dead. Long live public sector banks was a prevailing view for several years. In fact, one of the great pair trades over the last couple of decades was to simply short any government sector enterprise and go long its private counterpart. And in no sector were the differences in private and public sector companies more stark and in focus than in banking. Yet, if any pundits of the day had a crystal ball, they would have seen how wrong they would prove to be. In recent years, public sector banks have been some of the best performing stocks in the market, beating many of their much more fancied private sector counterparts. In fact, public sector banks have outperformed private banks over the last 5 years by an incredible 17 percentage points. So much for the death of the PSPs. But what has worked for these companies, and what explains the turnaround? There are 12 public sector banks currently listed on Indian exchanges. Bookended by SBI with a market cap inching towards 9 lakh crore and Punjab and Sindh Bank with a market cap of 22,000 crores. These companies have grown meaningfully in recent years, driven primarily by earnings growth. These 12 banks have compounded profit at 20.5% over the last decade and an incredible 52% over the last 5 years. What's interesting is that despite the run-up in the group's stock prices, it remains one of the few pockets where stock price performance has lagged behind earnings growth. On average, share prices for the group grew 38% for the last 5 years versus the 52% increase in profitability. Of course, you would argue they had some making up to do. But here's my favorite stat from the entire exercise. Despite the incredible run post the pandemic, the average share price gain for the group over the last decade is 4%. And 5 of the 12 are still trading below their prices 10 years back. Amazingly, only 3 of the 12 have witnessed double-digit returns for the decade. Canara Bank at 10%, SBI at 14.7%, and leading the pack, Indian Bank at 21.2%. Here's another fun fact. The average PAT for the group is 16,000 crores. The corresponding number for private banks? Below 10,000 crores. A point worth noting is that the PSU group can say, without exception, that all constituents are recording profits. A claim the private sector group cannot make. SBI is now the single most profitable company in the country. I'm not just talking about PSU banks or even banks more generally. I'm talking about the entire market. SBI is more profitable than Reliance and is as profitable as Infosys, Axis Bank and IOCL, which hold the 10th, 11th and 12th spots on the profitability leaderboard combined. While earnings have improved, valuations still reflect investor skepticism. The average PE ratio for the PSU bunch is 10.4 times. And average price to book is 1.27. A quarter of them still trade below book value, and only a third of them have double-digit PE multiples. These banks are also rewarding shareholders with distributions, with an average dividend yield of 1.9%. Of course, it's not all smooth sailing. While current returns on equity are over 14%, the average for the last 5 years is just over 10%. Critics, of course, will point to these as explanations for the multiples afforded to public sector banks by the market. But what are the corresponding figures for the more popular private banks? The average return on equity for private banks is 12% and 11% average over the last 5 years. So the question remains, why does the market still ascribe low valuation multiples to public sector banks, both in absolute and relative terms? This is not an easy question to answer. One explanation is that it's simply a function of history and anchoring bias. People are anchored to what they know from the past and therefore struggle to see a differentiated future. Another plausible explanation is that share price appreciation is a two-step process. In the first step, earnings growth exceeds price appreciation, and in the second step, multiples expand faster than profits. So maybe it's a question of when, not if. Now, it's important to recognize that public sector banks are deceptively large. They have books that are comparable or even larger than most of the biggest private sector counterparts. So any bear case for public sector banks has to hinge on, at least in part, fears of the quality of the loan books. The challenge with investing in any lending business is that you often only find out about the bad loans when it's too late. And as Buffett has always said, and Jamie Dimon recently reminded us, there's never only one cockroach in the kitchen. So whatever bear case exists must be a function of, in large part, question marks over asset quality. Now, whether those fears are misplaced or not can only be known with the benefit of hindsight. The hope is that banks have learned from lessons of the past. One thing I think is clear is that public sector banks have materially improved their service levels, even if there's still a long way to go. While the data points to the fact that large private sector banks are still the biggest beneficiaries of new accounts, PSU banks have undoubtedly attempted to stem that tide through better service levels and newer offerings. I will end by returning to how I began. Many shall be restored that now are fallen, and many shall fall that now are in honor. Let the PSU bank story serve as a cautionary tale of the pitfalls of believing that whatever happened in the past is what will happen in the future. Things constantly evolve in business, and all companies endure challenging times and enjoy glory days alike. Your job as an investor is not to fall in love with any company, but simply to take advantage of this reality. I hope you found this video useful. Don't forget to like and subscribe. Thanks for watching.